Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at plug power.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, let's unpack this. Imagine bleeding $1.22 for every single dollar you generate in revenue.
Oh, wow. Yeah, that is a tough spot to be in.
And doing that for an entire year, right? Now imagine pulling that exact business out of a mathematical death spiral to achieve a positive gross margin in just 12 months.
Which is pretty wild, going from a massive capital bonfire, which, let's be honest, the market has tolerated for a decade under the guise of green energy innovation, to actual operational discipline. That is arguably the rarest transition in the public market.
Totally. Most high-burn conceptual tech companies simply do not survive that pivot. Turning into a grounded manufacturing business.
Exactly. They just run out of cash.
So we have a massive stack of fresh data today, including their Q4 reporting and upcoming strategic roadmaps, and it's all pointing to a potential fundamental shift.
Right, because for years, anyone following the hydrogen sector viewed plug power as a perpetual survival mode play.
Yeah, they were sustained entirely by the future promise of a hydrogen economy, not actual profits today. So our mission in this analysis is to strip away all that historical hype. We are going to look strictly at the hard numbers, the mechanical changes they've made, and determine if this company is genuinely morphing into a commercially viable powerhouse.
Well, the focal point of this entire turnaround narrative sits squarely in the fourth quarter of fiscal 2025.
Right.
Every technical chart, every analyst rating, and every piece of forward guidance we analyze today radiates outward from that specific earnings report.
And the top-line headline numbers are undeniably large. I mean, fiscal 2025 revenue hit roughly $710 million.
Yep.
With fourth quarter sales alone reaching $225.2 million. That's a 17.6% year-over-year jump.
But honestly, revenue scale has never been Plug's primary issue, right?
Right. They have always known how to generate top-line growth. Their core issue has historically been absolute capital destruction.
And they finally broke that pattern, hitting a positive gross margin of 2.4% in Q4. That is the inflection point.
It's a huge swing.
It really is. When you consider that in the exact same quarter the prior year, their gross margin was a staggering negative 122.5%.
Wait, really? A negative 122%?
Yeah, the sheer scale of that operational recovery becomes pretty clear when you look at that gap. They aren't just selling more units to mask the pain anymore. They have fundamentally altered their underlying unit economics.
See, I have to push back on the permanence of that 125 percentage point swing.
Okay, fair.
When a manufacturing margin flips that violently in a single calendar year, my immediate suspicion goes straight to accounting gymnastics.
Oh, like pulling forward revenues.
Exactly. Did they pull forward recognized revenues? Or, did they temporarily freeze critical maintenance expenditures just to artificially inflate the quarter? Like, what actually structurally changed on the factory floor to warrant that kind of swing?
What's fascinating here is that the internal mechanics point heavily to a structural overhaul, not some spreadsheet illusion.
Okay, how so?
Well, management attributes this turnaround directly to a targeted internal initiative they call Project Quantum Leap.
Project Quantum Leap. Catchy.
Right. But beyond the corporate branding, this initiative forced a massive optimization of their whole hydrogen production platform. They completely overhauled their service costs, primarily by re-engineering the durability of the components inside their fuel cells.
Oh, so the actual physical parts are better now.
Exactly. If you can chemically extend the life cycle of the proton exchange membranes inside these cells, your warranty replacement costs just plummet.
That makes a lot of sense.
Yeah, you are rolling out fewer service trucks, manufacturing fewer replacement parts, and maintaining higher uptime. Combine that mechanical durability with securing cheaper renewable power agreements to run their electrolyzers, and the unit economics finally stop bleeding.
Okay, so based on those new unit economics, management is projecting some incredibly aggressive forward guidance.
Really aggressive.
They're targeting positive EBITDA by 2026 and full unadjusted profitability by 2028. But let's be honest, projecting profitability 2 to 4 years into the future is practically a beloved tradition in the renewable sector.
Oh, for sure. The skepticism is definitely warranted. However, Targeting positive EBITDA by next year means they are telling institutional investors that the core operational engine will be self-sustaining before you even factor in debt service.
Right.
And the 2028 full profitability target requires them to not just maintain these new efficiencies, but to scale them exponentially across their global footprint.
But you cannot scale that kind of operational efficiency in a vacuum. Those optimized electrolyzers and reduced service costs only translate to the bottom line because they have locked in a massive installed base.
Very sticky installed base.
Right, one that provides continuous, recurring demand. They currently have over 72,000 fuel cell systems deployed across more than 275 fueling stations globally.
And we are talking about the core internal logistics operations for some of the most demanding corporations on the planet. I'm talking Amazon, Walmart, Home Depot.
The big guys.
Yeah, these are companies that optimize their fulfillment centers down to the microsecond. And they rely on Plug Power for their internal warehouse fleets.
I know they've successfully infiltrated those supply chains, but I have to play the skeptic again here.
Go for it.
If I'm Walmart, my entire corporate identity is based on squeezing suppliers for every fraction of a cent. With lithium-ion battery technology getting cheaper and more efficient by the minute, why haven't these logistics giants simply swapped out Plug's hydrogen systems for a cheaper, commoditized battery competitor?
That's a great question. It really comes down to the physical architecture of modern fulfillment.
How so?
Well, a traditional industrial lithium-ion battery requires significant downtime to cool and recharge. And setting up massive charging bays eats up incredibly valuable warehouse floor space.
Oh, and floor space is basically money for Amazon.
Exactly. Alternatively, if you use a battery swapping model, you are dealing with massive weight and complex machinery just to keep a single forklift moving.
Right, that sounds horribly inefficient.
It is. Hydrogen fuel cells, on the other hand, can be refueled at a pump in about 3 minutes. And crucially, they maintain a completely constant power output until the tank is empty.
Unlike batteries, which degrade in performance as the charge drops.
Spot on. In a 247 Amazon facility, that continuous uptime and reclaimed floor space provide a massive operational advantage.
That dynamic functions much like a sticky software ecosystem then.
Oh, completely.
Once you've bought the iPhone, the Apple Watch, and embedded your life in the apps, switching to Android isn't just about buying a new piece of hardware. It is about painfully rebuilding your entire digital infrastructure. Plug Power has essentially made their hydrogen fueling infrastructure the iOS of Walmart's warehouses.
That is a perfect analogy. The switching costs are monumental. To move away from Plug, a client would have to rip out the specialized hydrogen fueling stations, sacrifice operational floor space to build new electrical charging infrastructure, suffer massive facility downtime, and retrain thousands of floor workers.
That sounds like a nightmare for a logistics manager.
It would be. Once Plug embeds that infrastructure into the facility, the recurring revenue from the ongoing hydrogen supply and the maintenance contracts becomes incredibly defensible.
And that highly defensible logistics baseline is clearly what is funding their aggressive vertical integration. We actually just saw a massive proof point on that front.
Oh, the Quebec project.
Yeah, they secured a 275-megawatt electrolyzer award for the high-2gen current project up in Quebec. We are stepping way beyond warehouse forklifts at this point.
Way beyond. A 275-megawatt project operates at heavy industrial scale. By securing massive international projects of this magnitude, Plug is positioning itself to own the upstream production of the fuel itself.
So they aren't just building the engines.
Nope, they're building the refineries of the future.
But moving from outfitting regional warehouses to powering heavy industrial grids is massively capital intensive. Building out a 275-megawatt project requires serious upfront cash.
It does.
And if you are an investor evaluating this company's future, you absolutely cannot ignore their brutal history in the capital markets. Over the last decade, Plug Power's outstanding share count is ballooned by nearly 700%.
Yeah, the market has a long, unforgiving memory when it comes to that level of dilution. For years, Plug treated the equity markets like an ATM.
Literally just issuing shares to survive.
Constantly issuing new shares to fund operations simply because the core business was hemorrhaging cash.
With that specific history, why should you, as an investor, trust that management won't just hit the equity ATM again to fund this massive Canadian electrolyzer project? The minute the stock shows technical life, what is stopping them from issuing another massive block of shares and completely crushing the current equity holders?
If we connect this to the bigger picture, management's recent financial maneuvering suggests they've finally recognized the market's absolute intolerance for further dilution.
Okay, so what are they actually doing differently?
Well, they exited fiscal 2025 with $368.5 million in unrestricted cash. But more importantly, they are aggressively monetizing non-core assets to build a firewall against near-term capital raises.
Ah, right. They executed a definitive agreement to sell their Project Gateway site, which guarantees them at least $132.5 million.
Exactly. That single real estate transaction is the anchor of a broader strategy targeting over $275 million in fresh liquidity.
And that's generated purely through asset sales.
Purely through asset sales and the release of restricted cash, they are systematically liquidating physical assets to buy financial runway. They're officially forecasting that this liquidity will fund all corporate operations straight through 2026.
Selling off physical assets to avoid tapping the equity markets is a classic corporate triage maneuver. It definitely stops the immediate bleeding.
It does.
But we also have to factor in the lingering legal overhang. There are multiple securities class actions moving through the courts right now. They specifically allege that management misled investors regarding the status of a potential Department of Energy loan guarantee.
Yeah, ongoing litigation of that nature acts as a persistent drag on institutional confidence. It demands management's time, it racks up significant legal fees, and, it creates a highly unpredictable liability profile.
Right. Risk-averse funds will actively avoid taking a heavy position until that legal overhang is fully resolved.
Definitely. But despite the legal clouds, the stabilization of the balance sheet through 2026 has clearly triggered a shift in market psychology. We've seen a dramatic recovery rally of roughly 116% over the past year.
Yeah, bouncing off a brutal 52-week low of just 69 cents.
A 116% rally captures attention, but technical analysts view this stock as deeply range-bound right now. It is currently building a higher base with key technical support around 50 cents, but it faces incredibly heavy overhead resistance near $4.50.
And the institutional sentiment perfectly mirrors this holding pattern chart formation. You see that divergence clearly between the covering analysts.
Oh, completely.
Susquehanna recently raised their price target to $2.75, but firmly maintained a neutral rating. They were essentially signaling that the downside risk is contained, but they need to see more quarters of execution before committing capital.
Right.
Then you have H.C. Wainwright maintaining a buy rating with a highly aggressive $7 target.
Yeah, Wainwright is pricing in a successful transition to profitability and likely factoring in the broader macroeconomic transition toward hydrogen infrastructure, whereas Susquehanna is sitting on their hands waiting for the Q1 numbers to prove the Q4 margins were actually real.
Here's where it gets really interesting. Beyond the predictable logistics business and the chart technicals, this stock has two massive speculative wildcards.
Okay, let's hear them.
I look at these as low probability, extremely high reward lottery tickets attached to the core valuation. First, they are aggressively positioning their hydrogen fuel cells as backup power solutions for AI data centers.
The physical logic behind that pivot is sound. AI data centers, specifically those running thousands of specialized GPUs, are straining the traditional power grid to its breaking point.
Because they require immense, constant baseload power.
Exactly. And traditional diesel generators are an environmental non-starter for tech giants trying to hit strict net zero emissions targets.
And I'm guessing batteries don't work for that either.
Right. Lithium-ion battery backups simply do not have the energy density or duration to sustain a massive data center through a prolonged multi-day grid failure. Hydrogen fuel cells theoretically solve both the emissions problem and the duration problem.
The logic is definitely sound, but it remains a purely theoretical revenue stream right now. We haven't seen the massive signed contracts to validate it.
Sure.
The second wildcard is that Department of Energy loan guarantee we touched on. We mentioned the lawsuit surrounding it, but the reality is there's a $1.6 billion loan facility that could be finalized if certain milestones are met.
A $1.66 billion injection of non-dilutive government capital would fundamentally alter their balance sheet overnight.
Overnight. It would be massive.
But DOE loan facilities are incredibly complex. They're driven by strict technical milestones and subject to intense political scrutiny and shifting administrations. The market is intelligently refusing to price a billion-dollar federal loan into the current valuation until the funds actually clear the bank.
Yeah, the market is finally forcing them to trade on concrete execution rather than narrative and speculative rumors. So, if you are tracking this stock, what are the actual calendar catalysts you should be watching for in the immediate future to see if this momentum holds?
Well, we should frame the immediate timeline against the broader macroeconomic backdrop first. The recent U.S.-Iran ceasefire agreement has driven a general de-escalation in the Middle East, which directly eases global energy costs.
And how does that affect both?
Plug Power's gross margins are highly sensitive to the industrial energy costs required to produce hydrogen and run their manufacturing facilities. This geopolitical stabilization acts as a silent, powerful tailwind heading into their next reporting cycle.
Okay, but the true test of those margins will be the Q1 2026 earnings report coming up in late April or early May.
Absolutely.
The market is going to aggressively dissect those numbers to ensure the 2.4% gross margin wasn't just a temporary anomaly. They will want verification that the core efficiencies of Quantum Leap are holding.
And they will want confirmation that the $132.5 million from the Project Gateway sale actually closed.
Right. But ahead of that critical earnings call, there is a highly unusual investor relations event scheduled. On April 16, 2026, the newly appointed CEO, Jose Luis Crespo, is hosting a Reddit Ask Me Anything session.
That is definitely unusual.
I have to pause on that. Why would the CEO of a publicly traded company with a highly volatile stock history subject himself to the unfiltered chaos of a Reddit AMA?
It's a bold move.
Bypassing Wall Street analysts to articulate a profitability roadmap directly to retail investors feels like an incredibly high-wire act of vulnerability.
This raises an important question about how leadership transitions are managed in the modern market. Cresto is viewed internally and by institutional analysts as the ruthless operational executor brought in to fix the machine.
Okay.
By going directly to the retail base, the exact demographic that suffered through the 700% share dilution we discussed, he is making a highly visible bet on his own transparency.
Right, because if he ducks the hard questions about capital burn and historical dilution, the retail sentiment will turn instantly toxic.
Instantly. But if he effectively and clearly outlines the path to 2028 profitability, he secures a fiercely loyal base of retail support. And that is critical when institutional money is waiting on the sidelines due to legal overhangs.
The overall consensus here consolidates this analysis into a bullish score of 7 out of 10. It's essentially framed as a medium-term hold for the 6 to 12-month horizon.
Yeah.
You are basically holding to verify the sustainability of the Q1 margins and watching for the physical execution of that 275-megawatt Canadian electrolyzer project.
It is a calculated optimism. The thesis is entirely dependent on their ability to maintain the structural efficiencies of Project Quantum Leap while successfully navigating the asset monetization strategy to avoid ever returning to the equity markets.
So what does this all mean? The data strongly suggests that Plug Power has crossed a critical threshold. They have validated that their internal restructuring isn't just management speak. It is mathematically tangible on the balance sheet.
Yep.
They are finally pivoting from a purely conceptual play to a disciplined operator.
And, for decades, green energy investing has been defined by utopian promises, visionary CEOs, and an almost complete disregard for cash flow. If Plug Power actually executes this roadmap and achieves full profitability by 2028, it forces a massive reevaluation of the entire sector. What happens to the market narrative when saving the planet finally sheds its hype and simply becomes a mathematically boring, highly profitable logistics business?
That is the exact kind of structural shift you want to look for. When the revolution becomes routine, the real money is made. Thank you for joining us on today's talk. Keep questioning the consensus, keep digging into the hard numbers beneath the headlines, and we will catch you next time.